Welcome back. Well, we continue to see high inflation despite efforts from the Federal Reserve to keep prices in check by raising interest rates. Those change in rates may soon hurt potential home buyers with higher mortgage rates. Now, according to a survey from the New York Federal Reserve Bank, the interest rate on a 30-year fixed loan is expected to increase to 6.7% next year. Now, if that happens, it would be the first time since 2000 that the rate went higher than 8%. So I want to bring in Tim Rood, head of government and industry relations for Citus AMC. He's also a former Fannie Mae executive. Welcome back to the show. So we heard where the New York Fed sees mortgage rates going. So where do you see them at, let's say, a year from now?
Yeah, hi, good morning. I don't see them going up that high. Look, I mean, the Fed obviously has to say these things naturally to as a counter to the breakneck inflation pace. I think it's a little bit of tough talking in a mirror. Look, they got to say these things, but then on some level, I think of the Fed, which is supposed to be an independent agency, is about as independent as my 15-year-old, right? I mean, they've got a $9 trillion balance sheet buying assets of all kinds to keep interest rates low. So if they do raise interest rates as aggressively as they say, they're basically going to take us into a recession, considering that real GDP right now is only about 1.5%. So I don't think that they're going to have the fortitude to really raise rates that high. I could see another 50 basis points, maybe 3/4 of a basis points this year. But a lot of this is also going to depend, the rates will depend on whether they start quantitative tightening and, selling off some of the assets on their balance sheet. So I don't think you're going to get that high.
Got it. So if the rates do reach these kind of levels, what will this then do to the housing market?
Well, you've seen rates go up about 2%. So look, a house you were looking at last year has gone up, 20% in value. Interest rates have gone up probably 2%. So that means 25-30% more a month in monthly payments. Good news is if you did buy a house last year, you probably made $60,000-$70,000 in appreciation, as opposed to renting, which has gone up 17% year over year, and you haven't made anything.
So for someone who may be in the housing market, I mean, we hear these numbers, mortgage rate hikes. What should they do? Should they sit out, wait, and hopefully things will get better in about a year or so?
I'll tell you, I don't think things are going to get better this year. Maybe next year it'll flatten out, but that's going to be after another 5-7%, appreciation level. What you're seeing really the trend right now is you have folks that are moving from like high, very expensive coastal towns or urban centers. And they're finding the more affordable outcome is if I move from, say, San Francisco or LA to Sacramento, it's like, do I care that the prices in Sacramento went up 20 or 30% over the last 2 years? No, because it's still about a third of what I was paying, of the value of the property that I was in. So I think it's a little bit of drive till you comply. I mean, because of the work from home trend, and it's likely to stay that way for a while, could even get higher. People are going to drive until they can comply. They're empowered by, rising incomes, or empowered by a strong employment market. So they figure that wherever they end up, they're ultimately going to be able to get a job, even if they can't work remotely.
Right. So what would be your advice to someone who is buying and looking to buy, and then advice for someone who is trying to sell in this market right now?
Yeah, I think that's the challenge for sellers right now is that unless they do, as I said, may move from one expensive market to a cheaper market, there's really no incentive for them to move locally, right? So normally about 80% of people move from, they move within, the same zip code or pretty close to that. Right now, that's less than 70%. People are just moving out of the area. So if you're a seller, I mean, you're kind of locked in, right? So you've got, I think 80% have interest rates at 3 and change or below, and they're fixed. So there's not a big incentive for them to actually move. Boomers are aging in place, right? So rather than going to a retirement community, they're aging in place. So I think for a seller, if you wanted to sell and move again to a cheaper market, this probably is a good time to do it this summer. If you're a buyer, I don't think you're going to get any bargains this year. I mean, I heard realtors talking just the other day, and they're like, oh my God, so interest rates went up, 200 basis points. So what does that mean? That means I got 8 bidders for every property instead of 16. I can live with that. We'll be fine.
Right. Another situation, though, what about renters who are looking probably to pay, at least a few $100s more in rent this next year? What should they do at this point? What's the lesser of two evils, I guess?
Well, I look at housing a little bit like I look at, like college education, right? It's like, should you get a college education? Of course. Should you buy a house? Certainly. Should you do either one of those at any cost? Probably not. Right?
Yeah.
So, I mean, I think it's all relative. The interesting thing is that as you see, there used to be I guess probably about 20 or so years ago when I first started in the industry, gosh, it's probably longer than that. Anyway, the rule of thumb was you should buy no more than 3 times your annual income.
Right.
Well, that made sense when you had interest rates that were 8 or 9%. Well, now when you have interest rates that are, say, 5% or 5.5%, well, then you can go up 4.5, 5 times your annual income. So, that rule of thumb has really kind of changed. If I was a renter, by hook or by crook, I'd find a way into the housing market because, again, it's a hedge against inflation, and no one ever made any money without owning something. So you got to own it to make the money.
Very true. All right, Tim Rude, Managing Director for Citus AMC. We appreciate your time today. Good to see you again.
You too.